So Colin brings a lot of experience, this was the formal part of it, but he brings a lot of experience, not just EFIC specific, I think it's fair to say, but sort of around this whole thing about, okay, we're going out there to export, how do we do this, how do we get the funding, how do we roll it out? So I think he won't mind if there's some questions that are a little bit broader than just specifically how does EFIC look. Is that right? So, welcome.
Thanks, Mike, and good morning to everyone. So what I'm planning to do is, as Mike said, explain a little bit about EFIC, who we are and what we do. And then we'll run through a couple of case studies which will highlight some companies that we've assisted over the last 12 to 18 months, just to give you a flavour of the type of company we assist and the way we assist them. And if you've got any general questions on exporting, on trade finance, feel free to ask those as well. So firstly, a bit of an explanation on EFIC. So EFIC, it's a specialist financier, and our role is to support Australian companies who are looking to grow their business internationally. So there's three types of companies that EFIC can assist. It's companies that are traditional exporters of goods and services. It's companies that are part of an export supply chain, and what I mean there is companies that may be not an exporter themselves, but supplying into an exporter. And a good example of that is a mining services company. And then thirdly, it's companies that are looking to go offshore, so maybe replicate what they're doing in Australia in an offshore presence. And I'll talk a little bit more about those in a moment. So 100% owned by the Commonwealth of Australia, so we benefit from the Commonwealth's AAA credit rating, and we do operate on a fairly arm's length basis from government, so we have our own board of directors, we're a statutory corporation with our own balance sheet, and we're actually trying to be a profitable organisation that pays a dividend back to the taxpayer. We operate on pretty much commercial principles, in the same way as a commercial bank would. But given who our shareholder is, they're not looking for the same level of return as a shareholder of a Westpac or a CBA. So what that means is EFIC can take a little bit more risk than a commercial bank would be allowed to do. EFIC's role is to fill what we call the market gap. And the market gap is the space in the market where commercial banks no longer have the risk appetite to provide financing, up to the point where it's clearly equity that a company needs into their business. So it's very much case by case as to how this market gap might arise. But generally in the SME space, and particularly the small end of the SME space, it's because a company doesn't have the tangible security, the bricks and mortar that the bank is looking for to provide a facility. So given that, we have a mandate that we don't compete with the banks. If a bank can provide the financing, there's not a role for EFIC, and therefore we have a very much a complementary role. We work very closely with the banks. And then finally, EFIC has a real focus on the SME market in Australia now. So this diagram just shows you why there's a need or a potential need for a government-owned entity like EFIC. You can see over the last couple of decades, there's a percentage share of overall lending. Business lending has decreased, and lending for residential and commercial property has been on an upward spiral. So there's a lot of reasons for that, but that highlights a bit of the gap where EFIC comes in to try and support Australian businesses. So in terms of the way that EFIC supports companies, if we break it down into those three different categories that we spoke about before, so exporters of goods and services, companies that are part of an export or a global supply chain, and then companies that are looking to go and expand offshore. So pretty much the same for traditional exporters and supply chain operators. We can provide bonding support, so that's advance payment, performance and warranty bonding, and I'll talk a little bit more about those in a moment. We can provide working capital support. The way we do that is generally through the provision of a guarantee to a company's bank, and the bank relies on that government guarantee as security in order to provide the lending facility. And then occasionally we can provide term financing. Term financing might be required if a company needs finance for capex, perhaps for equipment, in order to facilitate their exports. And then the main difference between those two categories of company is the ability for EFIC to lend directly to companies. So very shortly, probably in the next 2 weeks, EFIC will have the ability to lend directly as opposed to providing guarantees to a company's bank. And the government has done this in order to cut down on red tape, cost to SMEs, so and duplication as well with dealing with your bank and also EFIC. So what it means is EFIC will be able to basically place funds directly into a company's account, and then company would use that as working capital, deliver their contracts, and then repay EFIC. And then the final category, those companies going offshore. So what we're talking about there is companies that maybe want to go offshore, set up a sales office, set up overseas distribution, warehousing. They might want to acquire an offshore business, provided that that company is going to repatriate an economic benefit to the country. And in its simplest form, we're looking for a dividend to be paid back by the offshore entity back to the parent. Then EFIC can potentially provide support to those type of companies as well. So not exporters, but companies expanding offshore. Sorry, yeah?
So what do you mean by support?
So it would be financial support.
So similar to direct loan?
Correct, yeah. We couldn't provide a direct loan, but we would provide a guarantee to the company's bank, and the bank would then, on the basis of that guarantee, provide the financing. So whether it be working capital to set up offshore, or there's a capex requirement, that's the type of financing that EFIC would be providing them. So for that type of support, there are a couple of criteria. So one is that economic benefit. The second one is the company can't reduce their workforce here in Australia and then hire people offshore. So EFIC, as a government entity, we obviously can't be supporting the offshoring of jobs. So that's one of the key criteria. And then the third one is that we look at the domestic operation. So they need to have an existing domestic operation that has some good cash flow generation to service the debt that the company would be taking for that offshore expansion. So any questions on that different type of product offering that EFIC has?
No, sorry, just quickly, you mentioned looking to capex. Is it really an investment in tangible assets? I mean, versus expanding into a new market, which would entail a whole bunch of different expenditure. Your service, would that more target tangible investment in capex, or
No,
is it operating?
It could be for the operating costs, so staff
Okay.
is usually the big one that,
Yeah.
that we would be financing. So yeah, we're open, as long as it meets the criteria that I mentioned,
Yes.
What the actual application of the funds is used for,
Right.
provided it's related to the project in some way.
Yes.
But we're fairly open to that, yeah.
Okay, nice.
Yeah. So just run through some of the typical attributes of an EFIC client. So for EFIC, an SME is a company turning over up to $150 million. There's no minimum, but we do have a minimum in terms of the finance that we'll provide. So that's a minimum of $100,000. Generally, the companies that EFIC works with are growing companies. So they've got an upward trajectory, and generally we find that the company's balance sheet is not keeping up with the growth of the company. So they don't have sufficient working capital or equity or access to other forms of financing. Going back to what I mentioned earlier about EFIC plays in that market gap space, they can't get what they need from the commercial banking space. Generally, that's through a lack of security. And then finally, and this is quite important to EFIC, because EFIC is often lending on an unsecured basis, what we focus on is a company's performance capability. So we look at what their track record is of delivering either the same type of contract or similar contracts, either domestically or offshore. And that's how we gain comfort that if we finance a company, that there's a strong likelihood they'll be successful at delivering their contracts, and they will therefore get paid by their buyer, and the proceeds of that receivable repay EFIC. So that's what EFIC focuses on. It's all about performance risk, and we've got some technical people in-house that will actually do that assessment for us.
When you say repay EFIC, until the point in time you actually are able to advance funds, it's simply just a reduction in your guarantee, is that what you're saying?
Yeah, sorry, it's so it repay the facility that EFIC is guaranteeing. Yeah. When we've got the direct lending, yeah, it will be used to repay EFIC directly. So, just in terms of the support, all industry sectors, services as well as goods. Generally, what we've been supporting lately is advanced manufacturing, some general manufacturing. Mining services has been a big part of EFIC support, and food and agri. But it's pretty diverse. We're talking to some software companies at the moment. So there's no industry sector that we say no to. I've already talked about the different types of companies. And then also we support companies generally into most geographies, bar those that are on the sanctioned list. But we've supported companies going into different parts of Africa, South America in the past, so we're more than open to looking at that. Okay, we'll go through this fairly quickly. So working capital guarantee that I mentioned earlier, basically a guarantee, AAA rated that EFIC provides to the bank. The bank relies on that as security in order to provide the financing the company needs. And basically it's attached to either a specific export contract, or it can be to a series of export contracts that a company would have over the course of 12 months. And then that would then be a revolving facility that we would renew on an annual basis. The benefits, unlocks capital for company, it unlocks working capital for companies that they might not otherwise be able to obtain. Prevents companies from losing business because they say no to contracts because they don't feel that they have sufficient working capital to successfully deliver. And it really keeps businesses growing. Obviously, working capital is key to a company's success. Just very briefly, this is the structure. You've got an Australian exporter. They'll have a contract with their overseas buyer. They need working capital. They'll approach their bank. Let's assume they get knocked back by the bank. They will approach EFIC. EFIC will go through a credit process the same way as a bank would. Due diligence, and obviously, as I mentioned earlier, looking at that performance risk. If we're comfortable, we get a credit approval in place. We'll have recourse to the exporter. So in the event that our guarantee is called because there's a default, i.e. the buyer doesn't pay or the exporter doesn't deliver their contract, then the bank would make a claim on EFIC, and then EFIC would have a right of recourse to try and obtain those funds from the exporter, in the same way as a bank would under their facility agreement. So the bank would be providing working capital, and that working capital would enable the company to deliver their contract. Once they're successful at that, the receivable is due. That would then be paid into a designated account being held at the company's bank. And those funds are then used to repay the EFIC facility. This is very much a self-liquidating facility tied to either one contract or to the series of contracts over the course of the year. But basically, EFIC, a large part of what EFIC does is advanced payment performance warranty bonds, where a company will go to their bank. The bank will generally say to them, particularly if they're smaller, we need 100% cash security to issue a bond. That means that the company's working capital is tied up in a term deposit for the length of the duration of that bond. What EFIC will do, we'll look at that performance risk, and we can issue the bond. We will take 20% cash security. So it has the result of freeing up a lot of cash back into a company's business so that they can fund that contract they're working on or other export-related contracts. So I want to run through a couple of case studies. Probably won't go through them all. We've got about 10 minutes left. The first one is an interesting one. A company called PCT Global. This company based in Seven Hills, they've got a product called Enduro Shield. And what it is, it's a coating that you apply to things like glass, ceramic, stainless steel, and it provides a barrier on that surface, so it's very difficult for dirt, grease, etc. to stick. So what it means is the glass or the surface doesn't need to be cleaned as frequently, and it's also a much easier process. So this company has been selling their product commercially over a number of years, and that picture that you can see there, that's actually the top of the World Trade Center in New York. So they've had the Enduro Shield product applied to the spire, which was a great coup for them. They've been supplying their product also into Bunnings, so 250 stores across Australia on a retail basis. So this company wanted to grow their business further, and they recognised the only way they were going to do that is by going further offshore. And they identified the retail market in North America. So after fairly lengthy discussions, I think it took them about 18 months, they managed to secure their first contract with Home Depot in the States. Home Depot, similar setup to Bunnings, but they've got 2,000 plus stores compared to Bunnings' 250. So what resulted from that is there was a big working capital requirement that the company had in order to invest, to purchase raw materials and also ramp up production within the company, so invest in some additional resources. The company went to their bank. The principals of this company, relatively young guys, they didn't have any property security that they could offer to the bank. So the bank said, we can't help you, we need that security. So in this instance, the bank actually referred the company to EFIC. We went through that due diligence process. We provided them the facility of 650,000 US. That gave them that working capital in order to successfully deliver on that contract. It was a contract running for, first delivery was about a 4-month lead time, and after about a month of deliveries and receivables coming through, that facility was repaid. So all up, it was a 5-month facility. That company's now grown their balance sheet further, and they're looking to secure additional business from other US retailers and then take it to the DIY stores in Europe as well.
Yeah, time for another question. I've got one actually.
Okay.
I mean, I was advising a company a couple of months ago that they were sort of in a gridlock somewhat similar to this, where they were sitting on some very significant forward orders to the tune of, when I totaled them off for them, was basically they did not have the money to go and build the production equipment. So they had like sort of an early stage where they build a prototype, they could manufacture their thing, but it was sort of lab scale, large lab scale. Okay, we produce a kilo a day, but not a ton a day. These orders were tons, kind of thing. Is that so? Kind of this was to build the production and then fulfill these export, because all of the orders were for export. Yep. Is that something where you guys come in as well? Yeah, definitely. So, and we can look at term financing for that as well. Really? So yeah, if a company has to incur capex and they need financing for that, we can definitely look at it. We're looking at a couple of those at the moment where companies got some export contracts, but they need to ramp up production. They need to invest in machinery.
And so what would be the upper limit of your ability which I think you
The upper limit will be based on serviceability of the debt. Generally, because we're attaching ourselves to specific contracts, we'll be advancing a percentage against the receivable amount. So it's tied to the contract. But if it was a term debt, we'd be looking at the same way as the bank would in terms of what the serviceability is.
What's the length of the term of an export arrangement whereby EFIC will give funding in terms of the delivery of the product to before the the payment comes in. How far is the forward order? How far can the forward order go out to?
Okay, if we're looking at one specific contract, then we will provide our support for the duration of the working capital cycle. So if a company was building a piece of equipment and it was going to be an 18-month delivery period with peaks and troughs in terms of their working capital, then we will provide our guarantee for that period.
Right.
And the exposure will fluctuate. Yeah.
And even if there's staggered deliveries and payments over, say, a 2-3 year period, like a major contract whereby you've got to hold stock and deliver quick response as you go, is that something that gets factored in as well? Or?
Yeah, it does. It depends on if we would be looking at the contract. So if the contract is running for the same period, then we could potentially go out with the same duration. Yeah. Okay, no other questions? Thank you very much.
Thank you so much.